All right, let's get straight to it. This isn't your average market update. Think of this as a surgical briefing designed specifically for institutional capital. We're going to break down Hyderabad's 2026 real estate cycle, and we're focusing like a laser on the high-velocity investment pockets that are really going to define this next wave of growth.
So the first thing you need to understand is our core idea here, Hyderabad 4.0. You really have to forget the old stories about the city. It is completely decoupled from its old identity as just another IT hub. What we're seeing now is a totally new era, one that's not driven by wild speculation, but by serious institutional consolidation and just global-scale infrastructure.
So here's how we're going to tackle this. First, we'll unpack that big macro shift, the Hyderabad 4.0 concept. Then, we'll drill down into the massive infrastructure projects that are literally redrawing the map of the city. From there, it's a deep dive into the absolute premium market, Neopolis, before we analyze some other fast-moving pockets. And of course, we've got to stress test this whole idea by looking at the critical risks. And then we'll wrap it all up with a very clear allocation verdict for 2026. Okay, so let's jump into our first section, Hyderabad 4.0. You know, if there's one phrase that captures this new era, it's a structural flight to quality. This slide right here, it shows you the core dynamic of the market perfectly. Capital isn't just trickling into risky speculative projects anymore. No, it's being funneled big time into institutional-grade premium assets. You've got high net worth buyers locking in their money with the big, dominant developers. We're talking My Home, Prestige, the ones who guarantee execution and full RERA compliance. And RERA, that's the Real Estate Regulatory Authority. So this isn't a gamble anymore. It is a very calculated move towards quality.
Now let's talk about the engines that are really driving this cycle. It's so important to get this. These aren't just small improvements. These are mega projects that are fundamentally rewriting the city's economic geography.
First up, the Hyderabad Metro Phase 2. This is, without a doubt, the biggest urban mobility catalyst we're seeing. By linking that Western Tech corridor directly to the airport, it keeps that all-important walk-to-work premium alive, which is what commands those higher valuations. You can almost think of it as a peripheral liquidity hose. It's injecting an immediate and, more importantly, a quantifiable 12% price bump into these newly connected areas. Next, the Regional Ring Road, or the RRR. And look, this is not just a road. It's the backbone for a whole new satellite city model. The impact is just staggering. You can see right here that key intersections like Shadnagar are posting land appreciation as high as 42% year on year. It's turning what used to be simple plotted developments into these high-velocity industrial and logistics hubs. It's a total game changer. And finally, we've got the Strategic Road Development Plan. The key here is that this is no longer just a plan on paper. We're talking over 7,000 crores already invested. The flyovers and underpasses are up and running, and they are directly impacting property values. I mean, when you slash commute times by up to 25 minutes, that becomes a real, quantifiable metric that supports premium pricing for residential projects. It's lifting adjacent property values by a solid 8 to 10%. Okay, now let's zoom in, way in, right to the absolute epicenter of all this growth, Neopolis in Kokapet. This is, without question, the wealth creation engine of West Hyderabad today. The data here is just crystal clear. Kokapet has officially unseated the old guard neighborhoods to become the city's top-tier apex residential market. And that 37% year-on-year price surge, that's not speculation. It's incredibly targeted. The market has found its sweet spot. IT executives and corporate leaders who are looking for homes in that 2.5 to 3.5 crore range. And here is the really crucial point. The economics behind it all. Those landmark land auctions where plots went for 100 crores per acre, that fundamentally reset the entire market. I mean, think about it. At those acquisition costs, as this pyramid shows, developers are mathematically forced to build nothing but ultra-luxury, high-density skyscrapers. The math just doesn't work for anything else. This has basically set a hard floor for retail prices at 11,000 rupees per square foot, cementing the area's exclusivity probably forever. So what does that lead to? Well,
It's triggered what you can only call an amenities arms race. This table lays out the proof. You've got these institutional developers trying to one-up each other with massive clubhouses and interconnected sky bridges. The kind of stuff being delivered here now rivals what you'd see in Tier 1 global cities. And that brand trust? It commands a massive premium. Just look at my home Tarksha. They're leveraging their ready-to-move status to quote a staggering 14,000 rupees per square foot.
All right, so let's see how all of this builds out into a broader opportunity matrix. We're going to widen our lens now and look at some other high-growth zones to really understand their relative value and, of course, their risk profiles.
This matrix gives us a really clear strategic overview. You see Neopolis up there on the top row? That represents high-value stability. It's on a clear path to go past 15,000 rupees per square foot. Now contrast that with Teleport and Crore. The entry point is lower, but it offers a much stronger play on connectivity, with a projected upside of about 29%. See? These are very different entry points for very different capital strategies.
So if we drill down a bit on Teleport, this is the connectivity champion. It really is the primary value spot for that mid to senior management crowd. The sweet spot here is a premium 3-bedroom apartment between 1.5 and 2.2 crores. And you have projects like Prestige Golden Grove defining this market now with massive green spaces and 52-floor towers, which just signals that this area too is moving towards premiumization.
Okay, now for the aggressive early cycle play, we're talking about the southern frontier. This is the state's most ambitious bet on a totally new greenfield area. It's anchored by a 30,000-acre future city and a 200-acre AI innovation core. This whole zone is basically being built for a massive influx of workers from aerospace and the new AI industries. It definitely offers the highest potential return on investment for capital that's willing to get in early.
But listen, capital appreciation is only half the story. The cash flow here is really what holds this entire thesis together. You've got this flood of high-paying talent coming into the city for global capability centers, and that has pushed rental yields up to between 4 and 6%. Now, just to put that in perspective, the national average for major cities is about 2.9%, so Hyderabad is significantly outperforming. This provides a really powerful cash flow buffer that helps de-risk any long-term investment strategy.
Of course, this level of insane growth doesn't come without risks. And, no institutional analysis would be complete if we didn't stress test the whole thesis. So let's pivot and talk about the structural red flags that you absolutely have to do your due diligence on.
Okay, there are 3 critical risks that need your full attention. First, water scarcity. The rapid growth in those western corridors has completely outstripped the city's water supply, leading to a 70% groundwater exploitation rate. That's a huge number. Second, legal issues, specifically the lawsuits around GO 111, which is basically a set of environmental rules protecting the city's main reservoirs. That creates a very high risk of your capital being frozen in those areas. And third, there's a luxury inventory overhang from all those 60-plus floor skyscrapers, which has pushed the years-to-sell ratio up to 2.0. These are not minor concerns. They have to be underwritten.
So, having analyzed the massive opportunities and those very real risks, we finally arrive at our last section, the 2026 allocation verdict. This is our strategy for a surgical deployment of capital. Which brings us right to the single most important question of this entire briefing. Where exactly should institutional capital be deployed in Hyderabad for the 2026 cycle?
The verdict is pretty clear. For Kokapet, it's an aggressive buy. It is the apex asset, period. It's got deep institutional backing and a structural scarcity of land. For Crore and Teleport, also an aggressive buy, because they represent the highest potential return on investment. For Hyderabad, we're calling it a value hold. It's a high potential play, but you need patience for that AI city to mature. And finally, for Manikonda, our verdict is clear: avoid or exit. It's seen a sharp price correction, and it's just oversupplied in that mid-segment.
So to wrap this all up, the big picture growth story for Hyderabad is absolutely intact. But the key takeaway here is that performance is going to split heavily between different micro markets. The West is now clearly priced for that institutional consolidation phase, which leaves us with a critical question as we look to the future. Is the next high-velocity growth cycle already quietly beginning in the South?